all of the increase, I will argue, over the past 12 months. And remember, CPI is a lagging indicator. It's like the proverbial pig in the python. It just takes a long time to get through. And so basically what happened is we make the dumbest policy decisions in the history of mankind. Big statement, I'm prone to hyperbole, but this is, I believe this, right?
Is this too loose in 2021 or too tight in 2022?
The lockdowns.
Okay, yeah.
Policy. So not economic policy, not Fed policy. The lockdowns, okay? To take a flu virus and to lock people in their apartments and shut down the global supply chain will go down in history as the dumbest decision in the history of decision, right? I mean, I feel like I'm at Capital One commercial. Yeah. Just a bad decision. So, but that said, what did it do? Well, it caused a massive disruption in oil. Oil went to negative prices in April of 2020. Negative $39, okay? So then it got back to zero, and then it got back to like 40 and stabilized at 40, okay? Then it goes to 120. Well, how did that happen? Well, Saudi, during the crisis, sent tankers full of oil to Houston, to the ship channel, and filled up all the storage so no one could take their oil from West Texas and put it in storage. So literally drowning in oil, they have nowhere to put it. They have to pay people to take it away.
The price of storage was more expensive than the oil itself. So net, it's physical oil is negative. It was negative.
Exactly. Yeah. So then what did Saudi do? They went out and bought. So what happened? All the prices of oil companies went down 75, 85, 90%. And Saudi, which has a lot of money in the sovereign wealth fund, went out and bought them. Genius. I mean, mad genius. Manipulating markets? Yes. Illegal? I guess not. But they did that. So then what do? I'm like, well, now I'm going to cut supply. Oil will soar, right? Because we're going to unlock people and they'll have some more demand and we're going to control it. And oil tripled. And then what happened? Well, because of the lockdowns, you couldn't get stuff, mostly cars or chips. And so used car prices went crazy. I mean, literally, used cars were selling for more than new cars. And we had this weird anomaly that if you take those two numbers, it's 75, 80% of the CPI delta. Well, both of those are now going to go away. Yes. Literally going to go back to zero. In fact, might even go negative. I've made the argument that by the election, so we only got 4 weeks, I said oil would be $60 and gas would be sub $3 because that's the only chance the Democrats have to win anything. I mean, otherwise they're just going to get absolutely trashed. But I think Saudi is fighting them. The greatest time to invest, period, and it's exaggeratedly so in emerging markets, is when things go from truly awful to merely bad. Right? That is bar none the best time to invest, but it's the hardest. And in order to do it, you need three things. You need conviction, and conviction comes from work, doing the work in advance. You need courage. That's just intestinal fortitude to have a discipline. And you need cash. Having all three at the right time is hard, right? There aren't that many people who are willing to sit on cash and wait for that fat pitch. You know, Buffett says you don't have to swing. True. So I have this, I don't call him a buddy, right? But, you know, we're friendly and we actually invested. So Mike Alfred, and Mike's all over Twitter. And so he was very bullish on, and again, Mike, I'm not criticizing at all because I agree with you. He was very bullish on the miners, the Bitcoin miners.
Yeah, right.
And he bought them. And he was very loud about it. And again, I like loud. I'm not, again, that's not a criticism. I'm loud.
Loud's not bad. Yeah.
Loud is good. And he was very loud about it. And then they went down. And somebody said, what do you think? He's like, I'm all in. And then they went down again. And someone said, so now what? He says, well, I'm all in. He said, well, you were all in last time. What do you do? Where'd you get the money? And I think that is part of the challenge is any of us who invest, right? We have to balance a couple things. One, we have to balance rebalancing. Right?
Yes.
Should you sell your winners and buy your losers? Okay. Rebalancing is good on some periodic basis, but more interestingly, what you really want to do is cut your losers fast and buy more of what's working. So do more of what's working, right? That's actually the key. You know, Julian Robertson, God rest his soul, you know, just passed away a month ago, one of my mentors and just maybe the greatest investor of all time. And what I mean by that is not only was he a great investor in stuff, I mean, his long-term compound returns are off the charts, but his investment acumen at identifying talent, training talent, and backing talent, no one even close. There's no one in the same zip code. And so I would always ask people who were trained by him, you know, what made Julian so special? I said two things. One, he always said, okay, live to fight another day. You're not right. The market's right. So when it's going against you, get out of the way. Just live to fight another day. Go find another good idea. You got lots of good ideas. You're supposed to have lots of good ideas. And the second is, They said he had an uncanny ability to double up. When something was working, he would press the accelerator. Because most people—
And buy more.
Yeah, buy more.
Yeah.
And what Peter Lynch would talk about is most people do the opposite. Like to invest, well, you're supposed to pull your weeds and let your flowers grow.
Right.
Plant lots of flowers, but let them grow. Most people pull their flowers. As soon as you're up 10%, oh, I don't want to lose it. And then when something goes down, they're like, oh, I have to buy more because I'm right.
Yeah.
Maybe you're not right. We all know concentration makes you rich and diversification keeps you rich. So it depends, are you in the get rich business, right? If you're young, you should be taking more risk, not less. Right? You should be embracing volatility. You should be building bets in new tech. Like I always say all the time, if you're under 65, it should be against the law to own bonds. Right? You shouldn't own bonds, particularly under 45. I mean, literally, if you have 401k, zero in bonds until you're 65, 70. Mm-hmm. Just zero. You should have it all in high growth, innovative stuff. So, but I guess the last thing that I think is interesting, and on China. So there was an analyst that had worked for him, and he sent him over to China to do a bunch of research. And he went over and he met all these companies, spent 2 weeks, met all those companies, came back, and he had a list of 13. And Julian calls him in and says, okay, what do you got? And he hands him the list, and Julian's looking at it, and he starts talking and pitching his best idea of the 13. And Julian says, we're good. And he hits the speed dial and says, buy them. And the guy's like, well, I didn't make my pitch yet. He says, no, this is good. 13, I'll buy them all. And then the ones that go up, I'm going to buy more.
Yeah.
I'm like, genius, right? You had the great analyst go do the work to narrow the funnel to this is. And so the question is, should I buy BABA? Should I buy Tencent? No, buy KWeb because it owns, the top 10 or 15 or 20. And then the stuff that goes up, buy more. The banks might eke out some okayness because in crises, the volume of trading goes up and they take a spread. So, they may have skimmed enough off those derivatives to be okay, but I could see them getting hurt too with the rise in rates.
The Bank of England last week bailed out the British pension system, which was levered long duration bonds. You worked with Julian Robertson. You have a lot of experience in the hedge fund business, which is, basically about making as much money as possible. But then you also have experience working, with endowments, which is more about like long-term planning. And that is definitely where these British pension funds in particular are there doing something called liability-driven investment, where they're like, we have all these boomers who we have to pay pensions to. Basically, the boomers, we're short bonds. We're short the bonds, so we should be long bonds to match that thing. The problem is yields are so low, so they have to do all sorts of swaps and sort of wild things, or things that are safe when interest rates are non-volatile, but when interest rates are volatile, the Bank of England has to step in. What are your thoughts there? And then also, is this a harbinger for what's something to come with other central banks?
Look, they all got sold a bill of goods. First by Ray Dalio et al., risk parity. And look, when rates are falling, risk parity is awesome. Levering long bonds into falling interest rates, awesome. But to your point, as interest rates go lower and lower, that starts to break down. It's kind of like the Fed model, right? Everybody says the Fed model. As long as when interest rates are low, you should have a higher PE and you should have more equities. Like, well, yeah, that's fine to about 2%. Below 2%, the reason interest rates are low is because economic growth sucks. And so equities are going to do worse. So you shouldn't be levering up into that. But that said, when you get to that lower bound, the whole model breaks down. First, they were sold the bill of goods by Bridgewater et al. And it was awesome. And look, Ray's a multi-billionaire and I'm not. So I'm not criticizing Ray Dalio. Genius, mad genius. But the problem was, as rates went down, the trade wasn't working as well. And so what do? I'm an enterprising investment bank. I have a solution for you, Jack. Here's what you do. You lever, and we will provide that leverage through derivatives. No fee to you, no cost to you. And we'll take 4% out of this top, but you won't see it.